Hi everyone, welcome back to our podcast, Be Rich. Today we're going to talk about Market Spitznagel. He's another famous hedge fund manager in the United States. He's written this book called DAO of Capital. It is a book which came out in 2013. The complete name is called The DAO of Capital, Australian Investing in a Distorted World. The book is basically explores his philosophy of investing, which is known as the Austrian economics, and he mixes it up nicely with Eastern philosophy, the Taoist philosophy of the Wu Wei, which is non-action. And he talks about the roundabout approach of investing, which is the theory of that form of investing is instead of pursuing your objectives directly, you're better off taking an indirect approach to reach for a better outcome. And how does he do this? He uses his Austrian economic principle, which says that markets all have a natural cycle, economic cycle, like how we have weather patterns, and like how climate change is happening because of man's intervention and into climate is causing climate distortion. He also believes the same way human beings involvement in economic cycles, trying to control natural economic cycles through central bank policies, creates these distortions, these huge artificial bubbles in the market, which leads inevitably to a massive correction happening. So he draws example. His famous example he talks about is, of course, forest fires. That in nature you'll find bushfires are very normal, like it happens in nature. That's what lightning storms do. During the dry season in the savannah, the tall grasses dry out. Then before the summer rain comes, there's a lightning storm, starting a fire, a bushfire that burns down the bush, and the rains come in, ending the drought. And this creates a new platform for fresh shoots of grass and fresh life to come through. So he compares it to that, saying that this is a normal cycle that happens. But when we force markets not to do these patterns, we tend to create these artificial bubbles. And how does he mitigate against this this kind of a market cycle which is being artificially created by us? He does something known as tail hedge strategy, which him and both Nassim Taleb have spoken about, these black swan events. These black swan events are rare events which happen, but these unpredictable rare events cause significant losses to investors because of huge market corrections that happen. So he adopts a strategy called tail hedging. So what does tail hedging do? He buys insurance for his portfolio. How does he buy the insurance? He buys put options. I've spoken in another podcast or a video about this. What is a put option? So he uses put options as an insurance. So the way he does this is on the weightage of his portfolio. So let's say you have a portfolio and you feel of whatever your percentage of portfolio dollars are. You feel the market is going to go through a significant correction. So he starts putting a put for 1%. And as the market starts correcting further and further, he keeps increasing his put. He usually buys a put for the S&P 500. So he keeps increasing his put higher and higher to 20% of his portfolio weightage till the market correction happens. So, for example, let's say you have $10,000 in your portfolio and you buy a put option of 1%. So when the market is going very well, what happens? Nothing happens. Your equity portfolio gets better and better as the bull run continues, and you don't lose anything. But only thing which you will lose is a put option which you bought for that year, because every year that put option will expire, which will be a loss that you'll have to bear. But because the market is doing well and the bull run is continuing, you'll still see an overall net gain. So let's flip it around, and let's say you've been seeing the market correcting and you've been putting this put option, and finally it corrects, S&P corrects by 40%. When it corrects by 40%, most of your equity shares will have a huge correction and suffer huge losses across the board. But because you've been buying a significant put option for that cycle, you'd tend to stand as a net gainer because some of your heavy losses would have been recuperated by the put option which you bought, the insurance you bought. So this is known as tail hedging strategy. In the book also he talks about deep historical examples, historical context he gives about through history from ancient time, ancient wars to modern financial crises. He talks about them and he gives nice illustrations about these cycles which run. These called market cycles, and how people have profited from these market cycles by using this kind of hedging strategy and following this principle of Wu Wei, which is non-action. You should know when to react to the market and know when not to react to the market. And a bit of background about him is he's was originally from Morgan Stanley, where he started. He was a co-founder of Morgan Stanley's tail hedging fund, tail risk hedge fund strategy. He was the guy who brought it to Morgan Stanley. He left that and he started his own Universa Investments, a firm which he opened in 2007, and he did significant profits he bought himself and his clients during the 2008 crisis and the 2020 crisis. So why did I pick him today? It wasn't by random chance that I decided to talk about Mark Spitznagel today. I read an article which had come in Fortune and in Yahoo, where he talks about the current market situation. He feels we are currently in one of the world's, in one of the history's greatest debt credit bubble in human history, and he says it's getting ready to pop. But he says he's not very worried about it because of his investment. And in the article, he talks about the rising debt which is there in America, which he says is a big problem. In the article, he talks about the rising debt in America, which he says is a big problem. He says most households in the US have increased their debt, and he says there's a record debt of $17 trillion in the first quarter alone. And he says the global public debt is also surging to historic highs, like around 92 trillion, which is like a 400% increase since 2000, if I remember correctly. And he says the debt to GDP ratio, which is what you can look at a country's debt to GDP ratio to see if that's the ratio which is used to see if the country is able to pay its debt back, and if there's any problem in the country. The higher the percentage means the more challenges the country is facing to pay its debt back. It says America's debt GDP ratio has gone up to 118% for the first quarter. But America does have an advantage sitting in the reserve currency. So it does have that huge advantage compared to everybody else. And he talks about the American government and how they're growing interest expense in their balance sheet because the interest rates have been going up. So the interest payments which are needed to be made is also going up for the American government. And he talks about the credit rating, the American government's credit rating, which has been downgraded. That also shows the physical health of the American economy is not great. And he, of course, again talks about market implications. He says markets, retail investors are not reacting in the correct way. They're looking at inflation, thinking inflation's taken care of, and the earnings are all very good. And they seem to be flocking more and more money to the market and raising the prices even higher. And he also agrees with Warren Buffett, feels that American stocks are overvalued. So then the interviewer does ask him what does he recommend to retail investors. Well, his advice to retail investors is like what Anand's been saying, which is pretty much keep your investments long term. Don't try and predict the market and time the market. You'll end up burning yourself if you do that. And he says don't have knee-jerk reactions. He says you have some perceived threat you read about in the news or see a perceived threat and you start reacting to it. He says you can do more damage to your portfolio than the actual threat itself. And he says stick to your circle of competence. And of course, as Warren says, he says you can't bet against America for the simple reason of the reserve currency, like I said, and the American democracy being a plural and liberal democracy, which is one of the big pluses or positives that America has compared to the rest of the world, and there's no real threat to the dollar being de-dollarized as he sees. Marx Spitznagel's philosophy, the tail hedging strategy, which is buying options as insurance against these market downturns. But do remember you're paying a premium, which is a cost on your portfolio, and on good times you will not get anything from this insurance. Like you have car insurance, which you pay year on year, and if you don't claim that insurance, nothing you get out of it other than just having a protection. But in case something does catastrophic happen and there are bad times, you do recover quite a bit from these insurances. And remember, bull markets can drag on for a very long time, and the everyone wants to know when the bull market will end, when will the bull market end. No one can predict when the market will end and what will cause the market to end. But it is very clear that we are overstretched currently globally and even in India. So to keep all this in mind is what Mark Spitznagel said. I hope you guys do manage to buy this book, DAO of Capital. Please do read it. It's a very good read. I highly recommend it to all investors of all types and class. It's a worthwhile read. That being said, I hope you enjoyed the podcast today. Thank you for joining me on another podcast, and I'll join you again soon tomorrow, I guess. Bye.